Have you ever wondered how to assess the financial health of a company before investing in its stocks? One useful tool for this purpose is the Piotroski Score. Named after its creator, Joseph Piotrovsky, an accounting professor, this score is a numerical system that ranges from 0 to 9 and evaluates various aspects of a company's financial performance and stability. So what exactly are the components that make up the Piotroski score? Firstly, there's positive net income. The company gets a point if it had a positive net income in the most recent fiscal year. Next, we have positive operating cash flow. Another point is awarded if the company had positive operating cash flow in the most recent fiscal year. Then there's increasing return on assets or ROA. If the ROA in the current year is higher than the previous year, it gets a point. The next component is cash flow from operations being greater than net income. The company gets a point if this is the case in the most recent fiscal year. Lower long-term debt to assets is another important factor. If the ratio of long-term debt to total assets is lower in the current year compared to the previous year, it gets a point. Higher current ratio is also considered. A point is awarded if the current ratio, that is current assets divided by current liabilities, is higher in the current year compared to the previous year. No new shares issued is another component. The company gets a point if there were no new shares issued in the most recent fiscal year. Higher gross margin is also taken into account. If the gross margin is higher in the current year compared to the previous year, it gets a point. Finally, there's the higher asset turnover ratio. A point is given. The asset turnover ratio, which is revenues divided by average total assets, is higher in the current year compared to the previous year. Each of these components is assigned a point if the condition is met. The final Piotroski score is the sum of these points. The higher the score, the stronger the company's financial health. Investors often use the Piotroski score as a screening tool. A higher score suggests better financial performance and lower financial risk. However, it's essential to remember that the Piotroski score is just one piece of the puzzle. It's important to conduct thorough research and consider other factors before making investment decisions. Thanks for watching video. If you liked the content, do consider hitting like and subscribe button to remain updated with more such content.